In days of yore, budget leaks didn't happen. There were always a few rumours around, but on the big day itself, the Chancellor, who was famously allowed to sip whiskey during his, and it was always his then of course, during the biggest hour or so of his biggest day, he could bring out a couple of rabbits from his proverbial hat and surprise us all with his cleverness, or otherwise. The current modus operandi, it seems, is to allow as much speculation as possible, most of it apparently coming from behind-the-hands conversations in backrooms between those who might know, civil servants, and those who might want to tell everyone, journalists, running it up the flagpole to see if it catches the wind, throwing it at the wall to see if it sticks, chasing it down the platform to see if it catches the train. Pick your own awful corporate jargon. Now, the rumour which is getting most traction, more awful corporate chat, is the idea of limiting tax-free cash. It's certainly the one we're getting most phone calls about. Now, getting rid of it altogether for existing pensions would apparently need a change in primary legislation. You could do it for a new type of pension, but that wouldn't be an immediate money raiser, and there's no point in doing something unpopular unless it has an immediate dosh-raising effect. Because by any throw it against the wall and see if it sticks measure, it is causing worry and making many, especially the many unadvised, because apparently over 40% of those who take money out of their pensions do it without advice. It's making many preemptively take either or certainly a big chunk of cash out of their pensions. The main rumour is that the lifetime allowance limit on how much can be taken out tax-free will go down to 100,000. It's currently a rather cumbersome £268,275, so 100,000 would certainly be an easier number to remember, a round figure. As the average pension pot for someone aged 60 is apparently just under £80,000, which makes their maximum tax-free amount just under £20,000, I guess the government could comfort themselves that a majority of those beloved working people won't be affected by it. So, if you have a big pension pot worth more than, say, £500,000, should you be taking action? Maybe taking at least the amount over £100,000 as tax-free cash now. Well, if you have good use for it, why not? You can add it to your ISA, have a holiday, buy a nice Christmas present. But if you have a much bigger pension pot with a potential cash sum of nearer £200,000 or perhaps the current limit, it is a trickier question, or at least more nuanced. If you weren't planning to spend it now or have perhaps been taking it out as tax-free income on a monthly basis, for instance, leaving it in the pension means that over time your tax-free amount can grow as the remainder of your fund grows. Once it's out, you can only put it, once you've used your ISA allowance, into something, an account or an investment, which will be taxable. And once it's out, it's out. The regulator, the FCA, and the taxman, HMRC, issued a statement this week making it clear that the cancellation or grace period, which applies to other types of investment transaction, usually meaning that you have 30 days to change your mind, that won't apply to the taking of tax-free cash. So you can't, as some have thought, get it out a month before the budget and stick it back in if nothing happens. Now, of course, back in the day, before George Osborne's pension freedoms brought in the sort of flexibility we're talking about here, it was the norm to take out your cash and effectively cash in the rest of your pension and buy an annuity, an income for life, for better or some might say for worse. Maybe we're heading back that way. If we are, that will stymie the big change from last year's budget, inheritance tax being put on pensions, as no one will have any left when they die. Have I gone round in a big circle here? Am I advising you to take your tax-free cash if you're worried about it? No, because you're damned if you do and damned if you don't, and if she doesn't. And everyone's circumstances are different. I'd say talk to us if you're worried. My bet is that it won't happen, but then I'm the man who said they'd never change the inheritance tax rules on AIM shares because it would stymie growth and make that market crash. But they did. So what do I know?